Assalamualaikum and good morning everyone. Today we are from second group. We'll be sharing about Islamic insurance. Okay, so what is Islamic insurance? Islamic insurance, or we call as Takaful, is a joint guarantee or guaranteeing each other. The word Takaful stems for the word kafal, which means to take care of one's need. Takaful is a system of Islamic insurance based on the principle of ta'awun, which is mutual cooperation, and tabarruk, which is donation. The basic objective of Takaful is to pay for a defined loss from a defined fund. Each member of groups pulls effort to support the needy. It means the mutual help among the group. The operation of Takaful are within the tijari or commercial sector and is based on the Islamic commercial profit sharing principle of al-mudharabah. Okay, so basically, Takaful or Islamic insurance explains on how individuals are responsible to cooperate and protect each one another. Takaful is a type of Islamic insurance wherein members contribute money into a pool system to guarantee each other against loss or damage. So, move to the next one is the principle of Takaful operation. The principle of Takaful operation, the first one is it must operate according to Islamic cooperative principles, which is there is no oppression, clean and no bias and without coercion. The second one is the reinsurance commission may be paid to or received from only Islamic insurance and reinsurance company. So as we know, there are a lot of Islamic insurance company out there, such as Standard Chartered, Alliance, Prudential, BSN Takaful Berhad, Zurich Malaysia, and also Takaful Malaysia. The third one is the insurance company must maintain a participant fund and a shareholders fund. So the Takaful fund is managed and administered on behalf of the participant by the Takaful operator on the Takaful or the Islam insurance company. Next one is the element in insurance not conforming to Islamic law. There are three elements present in conventional insurance that do not conform to the requirements of the Sharia law, which is al-gharar, al-maisir, and al-riba. The first one is al-gharar. It means uncertainty. It happens when a claim is not made, which is one party or insurance company acquire all the profit or the premium, whereas the other party or the participant may not obtain any profit or whatsoever. It happens when the participant made a payment for the compensation and paying for the premiums. So, in conventional insurance, policyholders are not informed on how profits are distributed and in what the funds are invested in. That is the element of al-gharar. The second one is al-maisir, or we call as gambling. The policyholder contributes a small amount of premium in the hope to gain a larger sum. The policyholder loses the money paid for the premium when the event that has been insured for do not occur. The company will be in deficit if the claims are higher than the amount contributed by the policyholder. So al-maisir, this is the gambling element, which is in conventional insurance. The policyholder stands to lose all the premium that they paid if the risk does not occur. So on the other hand, he stands to get more should misfortune happen while paying a small amount premium. But in Takaful, even though the risk does not occur, the participant is entitled to get back the contribution that he has paid. So the last one is al-riba, or we call as interest. So usury is defined as the practice of lending money at exorbitant interest, especially at higher interest than it's legal. Usury or riba also refer to lending at interest or addition to the principal of a loan. Riba is referred to the interest factor present in the investment activity of conventional insurance companies. So the policy loan in conventional life insurance is in fact riba-based transaction. Islam prohibits any investment activity which are interest-based in alcoholic beverage and non-halal product. The next one is the importance of Takaful. The heart of insurance system is pooling resources from many to help the unfortunate few. Sharing the risk with the purpose of helping each other is recommendable, as Allah mentioned in the Quran. Help you one another in virtue, righteousness and piety, but do not help another in sin and transgression. Surah Al-Ma'idah. In Malaysia, the development of the Takaful industry was largely triggered by the decree issued by the National Fatwa Committee. Sheikh Dr. Yusuf Al-Qardawi suggested a modification to the insurance against the hazard to bring it closer to the Islamic principle by means of a contract of donation with a condition of compensation. For insurance to be accepted by Islamic tenets, it must be founded on the principle of tabarruk or donation and ta'awun, mutual cooperation.
As we know, Takaful has two basic principles, which is at-tabarruk and ta'awun. Tabarruk is an Arabic word that means donation or gift, and this contract of tabarruk is introduced as the basis of Takaful system, whereby the participant will agree to donate certain proportion of the Takaful contribution that he agrees or undertakes to pay, thus enabling the participant to fulfill his obligation of mutual help and joint guarantee should any of his fellow participants suffer a defined loss. The concept of tabarruk is selected as a fundamental contract in running insurance activities and transactions from the Islamic point of view. The contract of tabarruk is introduced as it is practical and safer. Each participant in a Takaful system allocates some or all of his contributions that be donated for the purpose of helping other participants facing calamities. In a simple analogy, participant A gives donation to help participant B, while participant B provides donation to help participant A. This mutual help situation is called Takaful, in which participants mutually help each other and not between participants and the provider, as what happens in conventional insurance system. Based on tabarruk principle, the contribution made cannot be returned back to the participant. Now we will move to the ta'awun. Ta'awun, or literally known as mutual assistance, forms the basis of many Islamic practices. Both social and economics includes Takaful. This principle allows participants to share their risk and exposure of risk with the intention of helping one another within the Takaful group, which means that through this principle, it is an arrangement whereby a group of participants each pay fixed amount of money, and the compensation for the losses of participants of the scheme are paid in lump sum amount. Now I will read the meaning of one of the ayat in Surah Al-Ma'idah. Help you one another unto righteousness and pious duty. Help not one another unto sin and transgression, but keep your duty to Allah.
Alright, the other part of Takaful concept is Al-Mudarabah concept. Mudarabah, that known as trustee profit sharing, is a contractual agreement that happens between a provider of capital and an entrepreneur for the purpose of business venture, whereby both parties agree on a profit sharing arrangement. Next, in Mudarabah, Takaful company acting as the entrepreneur and the participant that entrust funds to the Takaful company by means of Takaful contributions. And in Mudarabah also, Takaful contract specifies the proportion of profit to be shared between the participants and the Takaful company. Now, we go through the operation of Takaful. Operation of Takaful is a license and regulated by the Takaful Act 1984. The supervisory authority based under the Takaful Act is the Bank Negara Malaysia. Okay, realize the importance of complying with the religion of Islam. All businesses of the company will be transacted in the accordance with Islamic principles, rules and also practice. In Section 8, Takaful Act 1984, 3A, a religious supervisory council, who are the members of Muslim religious scholars in the country, shall be established to advise the company on the operation of its Takaful business in order to ensure that they do not involve any element that not approved by the religion of Islam. Number 5, the Director General shall also refuse the register an applicant unless he is satisfied. Okay, in B, that there is the articles of Association of the Takaful Operator concern provision for the establishment of a Sharia Supervisory Council to advise an operator on the operations of Takaful business in order to ensure it doesn't involve any element that not approved by the Sharia.
In Malaysia, there are two Takaful models, which are Al-Mudarabah and Al-Waqalah. Primary operating models in Malaysia are Ta'awuni model and Waqaf model. Ta'awuni model. So, Ta'awuni model practices the concept of pure mudarabah in its transaction, and it is a profit-sharing model. The Takaful operator and participant share the direct investment income, unlike Al-Waqalah, which is the Takaful operator of Al-Waqalah earns fee for the service of running the operation. In addition, Ta'awuni model's participant is entitled to 100% of surplus with no deduction made prior to the distribution. Pure Mudarabah model encourages solidarity, unity, brotherhood and mutual cooperation. Okay, so Ta'awuni model is divided into two basic models, which are Al-Mudarabah and Al-Waqalah. As I have explained before, Al-Mudarabah model is a profit and loss sharing model in which the participant and Takaful operator share the surplus, while Al-Waqalah is a fee-based model in which the Takaful operator earns fee for the service of running the operation. Aside from Ta'awuni model, there is Waqaf model. Waqaf model works on a non-profit concept, emphasizing the idea of donation among the participants. Waqaf model also initiates the Waqaf fund by contributing the initial sum into the fund, and participants make donation to help the less fortunate members of the community. Generally, Waqaf model undertaken by a social or governmental enterprises, and the surplus and profits resulting from the investment activities are not distributed to the participants, but are distributed to the less fortunate members of the community or society. Waqaf model also will retain by the operator to support the community. Last but not least, there are Family Takaful and General Takaful plans. So, Family Takaful, there are Al-Mudarabah model to act as a Mudarib, entrepreneur, while participants act as Rabbul Mal, the capital provider by paying contributions. And Al-Mudarabah contract is partnership in nature. And the other model is Waqalah model. For the General Takaful plans, there are also Al-Mudarabah and Al-Waqalah model. Right now, I am going to move on to the case analysis. The case that we've chosen is the case of Pertama Makmur Sdn Bhd against Leong Takaful Berhad. As all of us know, the Pertama Makmur is the plaintiff and Leong is the defendant. So, the plaintiff subscribed a Takaful insurance with Leong through a registered agent named Chong Wai Sung. But when the contract is about to end, the plaintiff then secured an extension of the contract, and the plaintiff had already paid the total premium sum to the agents for all extended policies. Subsequently, an accident occurred during the extension period, and plaintiff filed a claims under the Takaful contract for the loss suffered. It must be noted that under the Takaful contract, it required that the notice loss must be given directly to the insurer by the insured within 14 days of the accident occurrence. But the plaintiff had only given verbal notice to the agent, and it was found that the agent had misappropriated part of the premiums paid by the plaintiff and dishonestly forged an endorsement purporting to extend the period of Takaful coverage. Without the knowledge of the authorization or the defendant. The defendant averred that it was not bound by the conduct of its agent who fraudulently forged the relevant extension documents and appropriated the premium, whereas the plaintiff maintained that the defendant was responsible because the agents and the policy remain is still under the defendant. Hence, the present action filed by the plaintiff. So, from this case, we know that the principle applied was not comply with the rule and requirements of the Sharia, as it embodies gharar and uncertainty, which includes payment of the premiums. And other than that, the extensions of the contract also can be defined as voidable contract, as the insurance agent forged the contract extension documents. Under Section 17 of the Contract Act, a person who committed with an intention to induce another party into a contract may constitute fraud. So the agent is constitute fraud because the agent forged the contract extension document with an intention to induce another party into the extension contract.
So, based on the case study, the court held the forgery or counterfeit itself was neither authorized by the principal and nor did the agent had the authority to commit the same. But the forgery, while specifically unauthorized, was committed within the scope of the usual authority of the agent in the conduct of his business. The defendant was liable because the forgery was committed within the scope of his authority as an agent of the defendant. The law thus could not but rendered the defendant liable for the forgery of its agent. In the present case, it was not disputed that the payment were made to and received by the agent. He was the lawful agent of the defendant at the material time. Clause 1 of the Takaful contract deems payment made to the agent as being received by the principal. Based on the evidence and on the balance of language of Clause 1 of the Takaful contract, the purported cancellation because of the purported non-payment in full of the premium or Takaful contribution by the plaintiff was unjustified and wrongful. Based on particularly CLL 2.4 and 2.5 of the joint venture agreement, the plaintiff was unmistakably entitled to claim only up to 50% of the alleged losses suffered in accordance with its proportion to the plaintiff's share in the joint venture. On the totality of the evidence, the court found that the plaintiff had successfully proven its claim against the defendant on the balance of probabilities, who was therefore liable to the claims for losses under the policy or extended policy suffered by the plaintiff, which, however, was limited to only 50% of the total claim arising from the losses which in any event was to be assessed by the registrar. So, that's all from us. Thank you.